Module 9 starts a series of modules that will look into Chapter 5. And Chapter 5 is about the new revenue recognition standards. Chapter 5 is also appended with some of the old standards and the old practices that happen under the old standards. And so we're going to look at both the old and the new standards. The old standard is not too much to swallow. The new standards become a little bit more complex in their execution, which is ironic because part of the reason for the new standards was to simplify the accounting process. At least that was the original intent. And of course, intentions aren't always followed through on, and unintended side effects tend to start to occur as we implement new items. And I think that essentially what we found is that we replaced the old standards with something new, and yet still we have the same sort of issues cropping up where we have differences in industries, creating differences in how we want to recognize standards. And of course, we're going to have to see where all this dust settles eventually. But the new standards are set to go into effect at the end of December 2017. They were set to go into effect in 2016, but the FASB has delayed implementation of their issues. So looking at the old standards, remember we talked about the old standard already in passing with the revenue realization principle, or just the realization principle. We covered that in Chapter 1, and basically we said that revenue is recognized when it is realized or realizable and when it's earned. So what does that mean? Well, it's realized or realizable when goods and services are exchanged for cash or claims to cash. And of course, we would want these claims to cash be somewhat, enforceable, not just I deserve this cash, but also I have the means to go and claim it. So when we receive something of value for our product or service, any sort of a resource, an asset, we would say it is realized or potentially realizable. Right? It's earned when the earnings process is complete or virtually complete, and the company has accomplished what it must do to be entitled to benefits of revenue. So we've performed the services that we said we would perform. We have delivered the goods we've said we would deliver. And then notice, of course, we have this caveat of virtually complete. And this gave some level of interpretation to industries, where they could say, well, in our industry, we have virtually completed the earnings process by doing X. And then that would differ by industry, between industries, and their interpretation of this earnings process became somewhat problematic and led to a lot of sub-guidance and informal practices across different industries. So by the decision of the FASB and the IASB, this was a convergence project that they entered into. They wanted to redefine revenue recognition. They said that this two criteria policy was just too simplistic for the bevy of transactions that occur in today's economy. And if you think about it, there's a point to that. For example, think about when you just go in to buy a cell phone, all of the different arrangements, all of the different things that you contract for under an initial price in a contract, right? You have a delivery of the hardware. So they give you that right away at a point in time. Provision of services, that's ongoing data coverage, call coverage, use of their networks. That is over a period of time. The warranty coverage, also over a period of time. Software on the phone plus future software upgrades. So there's an initial point in time delivery of the software that is on that phone, and also there is the potential to upgrade for typically for free, future software upgrades that are tied to that. So it's a point in time, period of time. So we begin to get very complex, very hybrid type revenue transactions. And of course, to think of, and I just listed some below, but think of all of the different industries in which revenue recognition standards would change based on what the operations of that industry are. And you start to get this idea that perhaps just having two criteria was not enough. Maybe we have to go back to the drawing board and draw up something that's a little more fundamentally sound in order to have an enduring standard that will serve us. So some of the goals of the new standard are to remove inconsistencies and weaknesses in the existing revenue recognition requirements. The inconsistencies and weaknesses, again, typically arise from the interpretation of the earnings process. When it's complete or virtually complete, it becomes somewhat arguable. For example, a question on your test was about, is it acceptable to record revenue when you harvest gold because there are active markets? And the answer was yes. Under the old revenue recognition principle, it was acceptable because the earnings process was virtually complete. It didn't take much effort to actually sell it on a market. To improve the comparability of revenue recognition practices across entities, the comparability now arises. Remember, that's one of the fundamental characteristics of accounting information that makes it useful. We want to be able to compare two companies at a point in time. So across entities, industries, jurisdictions, capital markets, we want to increase the comparability of revenue recognition practices so that we can say, well, company A's practices match company B's practices, and we don't have to think about, well, what's in this revenue number for company A that might not be included in company B. To provide more useful information through improved disclosure requirements, what is required right now of revenue disclosures is rather patchwork. So there's not much there, not a lot of meat there. They typically disclose an overall policy of revenue recognition, but don't talk about, individual contracts or types of revenue that they recognize. It's rather sparse. So we're going to try to beef that up with this revenue recognition. And, time will tell how the economy or how the companies react to this and what kind of disclosures we ultimately get. Sometimes it's just, disclose more. And the companies have to kind of set the standard for what those disclosures entail. When we look at what's going on today versus under the new guidance, I'm not going to read through it all. I will call your attention to a few things. A few things that we'll look at, and you can kind of appreciate what you're learning and how it's going to change. So many goods and services are promised in a contract are deemed not to be distinct revenue generating transactions when they are separate obligations. So this is going to give rise to this multiple performance obligations, or MPOs. So again, think of the cell phone where they have multiple items that they are having to deliver on. And under the old contracts, sometimes those multiple obligations are not viewed as distinct. Well, we're going to introduce new criteria and new ways to deal with distinct items in a contract. The allocation of the price between those multiple performance obligations is not distinct. And so we're going to make a big deal about allocating the price between obligations. So if there's one price for multiple obligations, we want to be able to allocate it systematically between those allocations. And then finally, the variable consideration. We will talk about variable consideration between industries. Variable consideration is essentially when we may receive more or less money for certain items in the contract. Rebates, discounts, bonuses, rights of return are just some of them. Sometimes we will get incentive pay for finishing early, incentive pay for providing a certain quality of good. And so we will now start to more consistently across industries account for that sort of variable consideration. So looking at the new standards then, that was just sort of why we're doing this, where we're headed. It's always important to know the why of what we're doing. The new standards will go into effect in December 2017. Voluntary adoption can happen as early as this year. So there's typically, when the FASB issues something, there's a time when we can voluntarily adopt, and then there's a time when there's mandatory adoption necessary. The core principle is really kind of fluff, really straightforward. We recognize revenue for goods and services when that are transferred to companies when we're entitled to receive and exchange something for those goods and services, right? So I give a cup of coffee to someone when I believe revenue is recorded under a coffee exchange when I give coffee to somebody, and I'm entitled to receive the amount of money I ask for that coffee. So it's really pretty straightforward. Now, of course, they take the core principle and then they turn it into, well, here's the steps to make sure that happens. And this is where it gets a little bit more cumbersome. We identify a contract with a customer. This establishes legal rights for both parties. Now, this word contract is a little tricky because when you think of contract, typically you think of this long legal document that you have to sign and notarize, but this could be an oral contract. It could be an implicit contract. So it could just be that, for example, when you order something at a fast food restaurant, you are entering in a contract by just doing business there. When you go shopping and buy a new shirt at a store, you are entering in a contract. It's just a sort of customary business contract. And so it doesn't have to be spelled out. There's not anything you have to sign. You don't have to make some oral agreement and shake hands. And that is going to be, again, loosen up your idea of a contract. Identify the performance obligations in the contract. Performance obligations are just an item that is contingent upon the seller. So these are the obligations of the seller. That entitle it to receive that revenue. So, are they providing a good? Are they providing a service? Is it a little bit of both? The transaction price is the transaction price is the price you pay to facilitate the transaction. So, I pay a certain amount of money for someone being willing to give me a good or a service. The allocation of the transaction, this is when it gets, I think this is when students lose it a little bit. But what we do is, we identify, well, maybe there's 3 performance obligations, and then we pay $10 for those 3 performance obligations. Well, maybe I should put $1 to one of the performance obligations, 2 to the next one, and then 7 to the final one. And we're going to talk about how we do that, and that's something that we're going to work on a lot, and just it'll become more common sense if you apply logic to the process and not memorize it as always. And then we recognize revenue when or as each performance obligation is satisfied. So sometimes we'll recognize it right away because it's a point in time. Sometimes we'll recognize it over a period of time. So this is a pretty simple concept, and I won't spend too much time on it. But these are the 2 types of revenue recognition you will typically see. So a point in time recognition, typically related to goods. So that's when someone sells me an item and I take it into my possession. And here, of course, are some of the indications that I have control as a consumer of the product: legal title, physical possession, assuming risks and rewards, acceptance of the asset. I find it to be in acceptable quality and take it and drink my coffee. I don't return it and say, oh God, you didn't do this right. So all these sort of things can show evidence. Now, of course, not all these things have to happen, or just because one of these things happens doesn't mean that there is revenue recognition, right? So, but this is just a list of items that could imply we have control or that the consumer has taken control. Over a period of time is going to be related to typically services or discrete projects. What I mean by discrete projects, typically long-term contracts. So construction contracts, defense contracts, research and development contracts, contracts to provide services. I give you all those sorts of what could be discrete projects. When we want to recognize something over a period of time, it has to meet one of the 3 following criteria. And these aren't, so only one of these, it doesn't have to meet all of them. And typically, these again, makes common sense in a lot of cases. A lot of the times the customer will consume benefits of the seller's work as it's performed. So, consulting services, auditing services, anytime we deliver goods over a period of time, like a subscription service, well, I'm able to consume my newspaper, my magazine, as it is being delivered to me. If I join a gym, I am able to enjoy the benefits of membership as they provide those benefits to me over time, right? So this is kind of a catch-all for a lot of when we recognize revenue over time. The customer controls the asset as it's created. Now, for example, when I am giving a membership to the gym, I'm not really controlling. They're not really creating anything to me. They're giving me a service and I'm consuming a benefit from it, but I'm not controlling it. This is more about construction, the creation of an asset within a workplace, maybe a technology firm coming in and installing new computer hardware, firmware, that sort of thing, in order for us to more efficiently run the technology of our company. Updates and discoveries of research and development. So, maybe we've hired out someone for research and development, and they are creating knowledge and they are delivering that knowledge so that, this is mine. The research and development company is creating this especially for me. They cannot patent it for their own purposes. Anything they deliver to me is my knowledge, and I can brand it and patent it myself. The seller is creating an asset that has no future alternative use to the seller, has legal rights to receive payment for progress to date. Again, also typical in construction work, where they're building a building. They're not going to use it in their own operations. They are just going to sell it to somebody, and so it has no alternative use but to be sold. So let's look at an example then where we're allocating a transfer price. Remember, this is step 4. Allocation of the transfer price between a point in time and a period in time performance obligation. So now we have multiple performance obligations, and under the new revenue, we are going to put them between 2 items. So I'm going to use this one example of a gaming system. As an old gamer, this is kind of cool for me, but this is also something the book uses, and I thought it was a really good, easy idea for you to sort of get into revenue recognition with and multiple performance obligations. So we have a gaming system. It is sold with a gaming console and a subscription to an online network where we can get on and play each other, etc. Right? So I have some information about this. The package system is going to include both of these items: a gaming console and a password that provides 2-year access to a multi-user gaming system. This is a promotional bundle that we're putting together. Murbaden offers 1-year subscriptions for $50 a year. Murbaden sells the gaming console individually for $300 a year, and then the promotional bundle is going to be sold for $340. So how would you then decide to recognize this revenue over time? The idea is that, sorry, I'm shuffling my notes here a bit. So the idea is first, of course, recognize the contract, right? We do have a contract. The contract states that I have a gaming system with that will be purchased. Once it's purchased, I will deliver it. So that one's kind of a non-issue in this setting. Okay. What is step 2? Identify the performance obligations. Well, we have a performance obligation to deliver 2-year access, right? That's a PO. And also the gaming console is a PO. So we have 2 separate performance obligations in this one promotional package. Whenever you start to identify performance obligations, I'm going to give you a system. You can, do your own. You can come up with your own system. You can use mine. It's no big deal. But you have performance obligations on the left-hand side. You have a console, and then you have a subscription, so that you can kind of figure out what they, name them, keep them separated. And then once you have the POs, you then look at what we call the standalone prices of those POs. So they offer a 1-year subscription for $50 a year. That's a standalone price. And then this $300 is also a standalone price, which just means that if I was not going to enter this promotional package, I would have to buy it at $50 a year for a 1-year subscription, and then the gaming console would be $300. The promotional bundle selling for $340, because we're talking about the package console, right? We're selling that. This is the transaction price. So this is the price that these 10,000 package consoles will sell for per package, right? So what do we do with this information? Well, the first thing we do is look at the standalone prices and total them up for both. So we have a $300 price tag on the console by itself, and then we have $50 per year. And remember, it's a 2-year access. So this promotional package that I'm accounting for would actually be $100. That would be the amount of revenue, that would be the standalone price of this item. And we now get an idea of, well, how much should each one sell for, right? Well, we're not interested in selling them separately. We're interested in the total value, which is $400. Now, we want to figure out, okay, if we sold each of these alone, we would sell them for $400. Well, what percent would each item make up of that $400? So we divide each by the total that we just calculated to determine the percent of the total value we are buying with those two performance obligations separately. But remember, we have a special price. We're not going to pay $400 because we are buying it in a promotional bundle. That promotional bundle is selling for $340. That's the actual amount of cash that I am spending to get this. And that means that if we're considering the $340 price tag, then I would allocate $255 of every order to the console and $85 of every order to the 2-year subscription. Adding those together, we get $340, which we should get, right? Because what we're doing is we're just allocating this $340 between two performance obligations to figure out how much we would record for each one. So this is the amount of revenue I would record for each order as a console revenue event. This is the amount of revenue I would record for each order as a subscription revenue event. And then I would then multiply it by the 10,000 orders that I received for this item to determine what the total revenue recognition would be. We'll assume cash because I didn't tell you anything else. Then the cash would be the 10,000 orders times the transaction price, right? I would receive $3,400,000 in cash. How much revenue should I recognize now? How much revenue should I recognize perhaps in the future? Well, remember, now we think about period in time versus point in time. The console is a good that gets shifted in a point in time. The subscription is a benefit that is consumed over a period of time. So I would consume, or I would recognize the 255 times 10,000 immediately. So we'd record sales revenue for $2,550,000, and then deferred revenue for 85,000 times 10,000 be 850,000. So if you're doing this right, everything will add up because again, this is the transaction price. This is just allocating that $3.4 million between two sources of revenue generation. This, of course, increases my assets. This increases net income. And then the deferred revenue is still a liability account. So after this, we start getting into issues with the steps. We start enriching this with a little bit of complexity, but this is the basic fallout for this. And I wanted to kind of leave it here, go over this problem, make sure you understand every step. Do not, and I repeat, do not memorize, okay, I take this number, divide it by a total of this number plus another number like this number, and then I get a percent, and then I take that percent, multiply it by this number. Don't say this number. Know what you are doing. Understand the calculations you're making. What does this percent mean? Why am I taking 300 divided by 400? Well, that's because this is a standalone price, and I'm totaling it up with other standalone prices to figure out what proportion this standalone price makes of the entire bundle. Then I can allocate that to the transaction price, Then I can get the amount of revenue recognition I can actually record for each one. So make sure you tell yourself the story and make sense of it, because otherwise I guarantee you will screw this up. All right, I will pick up soon with identifying issues with different steps of this transaction.